Sitting at record highs with a monster week ahead. Less than 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, investors are gearing up for a host of events from Powell's testimony to earnings season.
Political risks also keeping markets on edge with a shocking surprise in French elections while Democrats debate Biden's future.
And Paramount officially agrees to a deal with Skydance, ending one of the industry's most dramatic acquisitions. Let's take a look at where markets are trading about 30 minutes until those bells ring. And it's pretty boring, I'll be honest with you. The S&P 500, after a big week last week, up about 0.1% pre-market. Similar story if you take a look at big tech. I'm going to go ahead and call that unchanged. Same thing, too, if you take a look at the bond market right now, currently flat on the 10-year yield, even though, like Sonali mentioned, there is a lot coming up this week.
All right, in terms of what I'm watching here, our first guest, Mike Wilson from Morgan Stanley, mentioned recently that economic surprises keep coming up to the downside. And that is true from the Bloomberg Surprise Index. Nonetheless, valuations keep rising. So if we're priced to perfection, what happens if things go wrong?
And Matt, there are a few shares that I'm watching before the open, of course. Of course, I'm watching shares of NVIDIA after a rare downgrade on Friday from New Street Research. Analysts at UBS raised the price target just this morning. That is divergence starting to form after a 154% rally this year. Also watching shares of Paramount Global gaining in the pre-market after finally agreeing to a deal with Skydance, handing control to media mogul David Ellison, a finale to one of the most dramatic M&A transactions in recent history.
Drama front and center as we kick off Bloomberg Open Interest. When I heard we were going to launch in July, I worried it would be a slow start, but there is so much going on.
So much to cover, so much to talk about. And you think sort of the guiding mission for this show is really about telling the macro through the micro, and we have a lot of macro to talk about.
We certainly do, and against the macro, of course, we have a U.S. election season just started heating up. Democrats starting to question the future of President Biden. Also, those elections yesterday in France, as you were talking about, showing the power of the far right, the far left. And guys, that's also a dynamic playing here at home.
Of course, we also have Powell coming up this week, so don't forget about him as well. We've got an all-star lineup ahead of us, and Morgan Stanley's Mike Wilson, State Street's Marija Veitmane, Bridgewater CO-CIO Greg Jensen, Howard Marks of Oaktree Capital, and in today's C-suite, we also have Anthony Smurfit. He is the CEO of Smurfit Westrock. It's one of the world's largest packaging companies, plus the CEO of Lamborghini. I'm kind of out of breath just reading it, Matt.
I'm looking forward to talking to Stephan Winkelmann about Lamborghinis. And on this program, I think it's fair to say we can focus on car CEOs, at least count on at least once every couple of weeks. Let's get to our first guest, though, firmly focused on stocks. He's one of the last bears remaining down on Wall Street. Morgan Stanley's CIO and Chief U.S. Equity Strategist Mike Wilson joins us at the desk this morning. And Mike, it's great to have you to kick off the program. Thanks so much for coming in to be our first guest. What do you think about the valuations I showed just a moment ago? If you type ECSU on the Bloomberg terminal, you see economic surprises, and they continue to come out to the downside.
Yeah, look, we're in this period where bad is good for multiples, right? So slower growth, as long as it's not a recession, brings down inflation expectations, which allows the Fed to cut. And that's what the market has been anticipating now for almost a year. Now, they've been wrong about the number of cuts, but the conclusion the equity market is making right now is that, well, there's not going to be a hike. And we know the direction of travel is down. That's fine so long as that negative growth surprise doesn't turn into a hard landing. And right now, that's not the case. Now, the labor market is showing signs of weakness, but not to the degree that would freak out equity markets. And so what's going on is the markets are very efficient right now. They're basically putting money to work in high-quality growth stocks. They're paying up for anything that has growth because that's what the market needs. Growth is scarce. So people are saying, well, the market should broaden out. It's not going to broaden out if this continues, but it also doesn't mean that we're going to collapse until there's either evidence that we're going to have a hard landing or there's evidence that we're going to reaccelerate and then the Fed can't cut and rates go higher. So we're stuck. We're stuck in this sort of environment that really a lot of active managers don't like because it's narrow, it's hard to pick stocks again, and it's hard to outperform.
Hard to outperform. It sounds like what you're saying, though, is that at the benchmark level, that narrow breadth, it doesn't necessarily mean that returns will be weighed down.
No, not necessarily. And we did some work on this the last couple of weeks that shows that when breadth is this bad, and by the way, it's historically bad, it's a 50-50 chance that it's bad, and it's 50-50 chance that it's good for the overall S&P 500 index. And so we play this game until it ends. And the game will change. The question is it going to be a situation where you have everything gets corrected lower, or can it broaden out to small caps, to more cyclical stocks, to other assets that don't have a multiple 40 or 50 times?
Mike, you've written recently also that investors are increasingly becoming concerned about higher rates, perhaps even a rate hike down the corner. You look at this year and expectations for September, for example, but then you look on a longer horizon and the worries about fiscal spending here, spending from either a future Biden administration or a future Trump administration. How much worry do investors really have under the surface, and how could that throw the entire storyline off course?
Right now, that concern is not there. Okay, and the way we measure that concern is the term premium. So rates have gone up this year from January, and it didn't affect the overall market multiples because it was not about term premium, meaning concern about fiscal, sort of spending. It was about growth being better and, quite frankly, inflation being better. Now, there's a misnomer out there that higher inflation is bad for stocks. Not true. Higher inflation is good for smaller stocks. It's good for the average stock. What we have right now is we have a disinflationary boom, which really means that the few stocks benefit. So I don't think it's a risk now, but with our election, with the elections overseas that are going on, and more importantly, just the fiscal spending that's going on regardless of the outcome of the elections, I think it could come back into play later this year. One thing we're watching very closely is how they're funding the government. Okay, so we have the reverse repo, which is pretty well understood at this point. There's about $400 to $450 billion left. They can use that to fund bill issuance effectively. They still have a fairly large Treasury general account, so if they need to tap into that because they don't want to issue as much paper, they can do that. And then they still have the Fed, which is going to start curtailing QT now, which is effectively QE. Right? If they start reinvesting, which is what the end of QT is, that's about $600–700 billion annually of bond purchases. So they have the liquidity provisions in place, at least through the end of the year, I would argue, and then we'll see. So 25 could be a bigger challenge for that term premium.
Do they have to go the other way? Does the Fed have to go the other way if Trump wins in November? Because he's talking about massive tariffs on the Chinese. He's talking about deporting millions of people from the U.S., obviously shutting down the border. That's all incredibly inflationary, right? Or it could be, at least according to Larry Summers.
Yeah, it could be. I think the Fed is going to be patient on that because, look, I mean, these things all lag. Right? Even if those things happen, it won't take place until the first, second quarter of next year. And then the impact on the actual data will be a year from now. So I think the Fed is probably is on track now. I think they want to cut rates. They want to cut rates more than 25 or 50 because the curve is inverted by a significant amount. So
25 basis points doesn't do a lot.
I don't think 25, 50 basis points changes this dynamic that we're seeing in the equity market, meaning the kind of scarcity of growth, paying up for growth in a way that we've been seeing. Now, if we were to get 100 basis points or 150 basis points of cuts without a hard landing, then we could maybe see some rotation away from these leaders.
Well, we'll see, of course. So far, the data hasn't even allowed them to do 25 basis points. So we'll see if that starts to cooperate. I do want to talk about earnings season, because in addition to this show launch, we also do have earnings season kickoff this week. And I was taking a look. If you take a look at expectations for 12-month forward earnings, they're at all-time highs right now. I mean, how high is the bar for corporate America, and can it actually meet that? It's
actually an interesting kind of observation, because the reality is, yes, forward 12-month numbers are going up, but they're going up because we're moving out in time. And I would argue that 2025 estimates are, no one's even really done the math on that. No one has really actually calculated no one's estimating 2025. All they're doing is estimating the next 2 quarters and then rolling forward some sort of growth rate. So I would argue that earnings estimates have been coming down on a quarterly basis. Like for the last 18 months, each quarter gets revised lower. They jump over the lowered bar. And that's exactly how we're set up for this quarter, again, which is that earnings have been coming down. They'll probably meet the expectations, beat them. And this is where I think we could start to see 25 estimates come down. Typically, in the second half of the year, the market and analysts start to look ahead and say, actually, 25, we're going to have to revise this. And the wild card is starts with the fourth quarter of this year. That's the big hockey stick of expectations. That's where the expectations get challenging. And the question is, can companies manage that in a smooth way between here and the end of the year?
Morgan Stanley's Mike Wilson sticking with us. And coming up next, we're going to talk about Hurricane Beryl making landfall in Texas. We're going to analyze the impact on energy markets next. Stick with us. This is Bloomberg. We're now back with Morgan Stanley's Mike Wilson, the CIO and Chief U.S. Equity Strategist. And of course, we were talking a little bit earlier about earnings season, Mike. And we have this situation where you have high hopes, high expectations. How much can these companies start to deliver here? How much of an issue are they going to have if they don't?
Well, I think this is one area where, once again, bad is bad. Okay, so I would argue that, weaker economic data is potentially good for multiples generally, at least if you're delivering on the earnings. But if you have bad earnings reports, you're going to get punished. And that's been consistent all year, which is why the average stock is down this year. The average company has not had good earnings results.
That's a good point to make, Mike, by the way, because we talk about, Jess Menton from our equities team writes about this earnings expansion that we're in, 3 quarters in a row of growth, but it's only 7, 8, maybe 10 companies. The other 490 in the S&P are not doing well. So what has to happen for them to grow, to increase their earnings, to do well?
Yeah, well, first of all, it's more than 7 companies, but it's not more than probably 30 or 40. So it's narrow. It's like a nifty 50 almost is where I would characterize it. Now, what needs to happen? Once again, we need the Fed to cut meaningfully. We need the curve to re-steepen. We need cost of capital to come down. We need the labor markets to loosen up in a way where these smaller businesses can actually hire people at a reasonable price. They need pricing power to come back. One thing that gets overlooked is companies are losing pricing power now. So while we're all rooting for lower inflation, once again, weaker inflation is not great for earnings. Small cap businesses, small cap companies like Russell 2000 typically only does well coming out of a recession, coming out of a new cycle. Why? Because rates are low, curve is fully steepened, access to capital is abundant, and they have operating leverage again. That's just not where we are. So we need rates to come down as number one, or we need some sort of exogenous positive shock on the growth side that doesn't lead to an inflationary problem. So you tell me where that's coming from. I think it's going to be it's a challenge, and that's why we're not going to fight this trend. I mean, the momentum is so strong because it's right. Now, what worries me is that momentum is so strong and people have a lot more exposure to high multiple stocks than they think they do. And if you have an event that's unpredictable, then you could have a real reset on valuation of 10, 15%. Like, I think the chance of a 10% correction is highly likely sometime between now and the election. Not just because of the election, but because uncertainty is going to prevail for a lot of different reasons. Earnings reasons, election outcome reasons, some of the things you mentioned earlier around tariffs, potentially immigration, Fed policy still remains uncertain. So yeah, I think the third quarter typically is that period, and it's going to be choppy. Now, we're hoping that's going to create some opportunity, but like right here, valuations to me look very, very unexciting.
And it's a great point, too, on you might be more exposed to tech than you think, especially if you're sitting in the S&P 500, which is, 30% tech or so. I do want to actually talk about how all of this rolls into price targets. And typically at this point, I would ask you what your year-end S&P 500 forecast is. But I know that you've backed away from those sorts of calls. And it was interesting. If you take a look at Friday, we got some news from Piper Sandler saying that they're actually going to drop their S&P 500 forecasts, that basically it's bad practice. And when you think about that, I mean, are we starting to see the beginning of the end of these big, bold S&P 500 forecasts?
Well, no. What we did is we rolled forward our forecast 12 months in May. So we took away our year-end target. And look, first thing I would say is S&P targets at a certain time and price is kind of silly. But what I would tell you is that the risk reward from here we think is lower. Like over the next 4 to 6 months, for the same reason I just mentioned, we have volatility probably picking up in the third quarter. I would say your likelihood of upside between now and year end is very low, much lower than normal. I'd call it 20, 25% that markets are higher between now and year end. Okay, specific target, I don't know, but let's say it's down 10% or so. Then we would get interested. Then we'd be interested to say, okay, maybe there's some things happening at the index level. Where the opportunity remains is at the stock level, at the factor level. Okay, and in that regard, we still like sort of growth, but not just quality growth, but like quality in general, large cap, good balance sheets, companies that can deliver on earnings, and that momentum will continue. It's just hard to find companies that are cheap. So if they were to come in 10%, then we would probably get interested again.
Hey, Mike, elephant in the room here. Theory of strategy. You just lost perhaps your biggest competitor on Wall Street, had stepped down from his post at JP Morgan. Does that put pressure on you to really move forward with cautionary tales here? There are just fewer bears on Wall Street.
Yeah, I mean, and look, I would say we kind of pivoted on that already. Beginning of the year, we sort of moved away from being too bearish. But at the end of the day, it's a tough gig. I mean, trying to predict, once again, S&P 500 is certain, and that's not an excuse. That's what we get paid to do. Sometimes we get it right, sometimes we get it wrong. And look, it doesn't put any pressure on me to do my job any different, right? Just like being wrong doesn't make me feel pressure. Oh, but now I have to change my view completely. The way we get paid by clients, institutional clients, is to give them a good analysis, a good framework so that they can make their decisions on how I should be investing. And that process will never change.
Well, you've done that for us, so we really appreciate you coming in. Mike, thanks so much. Mike Wilson there, Morgan Stanley's CIO and Chief U.S. Equity Strategist. Let's get now to high interest to look at what's making headlines around the world. President Biden says any weakening of resolve only helps Donald Trump and reiterates that he is staying in the presidential race. Biden's campaign just released a letter from the president addressing Democratic lawmakers who want him to stand back. Several influential congressional Democrats said on a private call they want the president to step aside. He registered his best showing yet, though, in a Bloomberg News Morning Consult tracking poll of battleground states. He still, of course, trails Donald Trump. Boeing will plead guilty to criminal conspiracy to defraud the U.S. after violating a DOJ deal over fatal 737 MAX crashes. The plane maker faces a fine of as much as $487 million. And the crew of a NASA mission to Mars emerged from their craft after a year-long voyage that never left Earth. The 4 volunteer crew members spent more than 12 months inside NASA's first simulated Mars environment at Johnson Space Center in Houston, coming out of the artificial alien environment Saturday around 5 p.m. Hurricane Beryl made landfall on the Texas coast, bringing with it a life-threatening storm surge and putting natural gas and oil infrastructure at risk. It's expected to weaken as it passes over eastern Texas and Arkansas.
And let's take a closer look now at how Hurricane Beryl is impacting oil companies. Of course, as it makes landfall, you have ExxonMobil adjusting some operations, while Freeport LNG ramped down liquefaction operations with plans to resume once the storm safely passes. Bloomberg's Alex Longley joins us now with more details. And what sense do we have of how this will impact production levels?
I think there's a few things to look for, particularly on the oil side. I mean, when these storms hit, the first thing that you see impacted is the Gulf of Mexico production. We saw a small hit to some fields, some adjustments in production in the US Gulf of Mexico. The next question, and the one that we're grappling with this morning, is a combination of things. The first will be the impact on refining and whether the storm has any sort of major impact on sites that are in Beryl's path. And then the second one will also be the impact on exports. Don't forget, over the last few years, the US has become the world's oil supplier of marginal resort, where on any given week, we're seeing 4 or 5 million barrels a day of crude exports, and US barrels now set global prices. So disruption there is the thing that's likely to potentially tighten global markets. And if we get disruption at refineries as well, then that's going to tighten fuel markets if it lasts over the long term.
Alice, can you do just that? Talk through the exposure that different companies have, whether it's refineries or otherwise, throughout the region.
There are various different companies. Again, I'm more on the market side, but the majors will all have Gulf of Mexico assets on the production side. They're often the first to lock in and shut down production, given the risks to both personnel and the environment in the area. And then also, you have the majors, so Chevron, BP, Shell, with various different assets in the region. Particularly on the US side, you have refining assets there as well. And also some of the refineries are owned by. You have, for example, Motiva, a joint venture with Aramco. So yeah, you have a whole host of companies across the board. I mean, the thing to keep in mind as well is the US is just one part of many of these companies' footprints.
Right. What's the diesel picture look like, Alex? Because in the past, that's where we've seen big spikes, and obviously that causes more of a problem for the economy because it affects shipping.
Yeah, exactly. And the diesel market's an interesting one at the moment as well. It has for a long time been what everyone's looking at as a kind of bellwether of the global economy. And both on diesel and gasoline, I think people are gearing up for a bit of a spiky summer because of the risk of storms. Not just Beryl itself, but the way in which Beryl has come about. The fact that we're seeing a big storm so early in the season. Normally when traders are looking at storms that might disrupt refining in the Gulf of Mexico, we're looking at things that are coming in August or September, not this early on in the summer. And so to your point about diesel, I think although the market is sort of it's been sort of steady in a strong position for the last few months, and varies between region as well. We've seen perhaps more weakness in Asia than we have in Europe and the US. But I think what people are worried about, particularly as you get into kind of thin volume trading over the summer and the risks of a big supply, is the risk of low volume is that we get a big supply disruption in this period where large parts of the market are away on their summer holidays, and that could be hugely disruptive, as you say, not just to the global oil market, but to consumers and freight across the globe as well.
Bloomberg's Alex Longley, we thank you so very much for keeping an eye on the situation for us. And coming up next, we're going to take a look at the companies making the most buzz on social media today. That is Social Climbers up next. This is Bloomberg. Time now for Social Climbers, the companies making waves on social media this morning. First up, Microsoft is telling employees in China to keep their Android-powered smartphones at home. Beginning in September, China-based employees will only be able to use Apple iPhones for work. Microsoft has not yet cited the reasoning behind this move, although the tech giant has been ramping up its cybersecurity efforts. Next, the specialty glass company Corning is raising its second quarter sales and profit guidance after a strong performance by its new generative AI products. Go figure. Finally, a battle is brewing at Sam's Club. Members are up in arms after the Walmart-owned chain announced it will remove free shipping for all items starting in mid-August. Instead, customers will have to spend at least $50 to qualify for the perk. Some disgruntled members are threatening to take their business to its rival, Costco. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. And guys, if you had a Sam's Club membership, would you be mad?
I don't think it's possible to go into one of these big box stores and spend less than $50. I don't know how that would happen. And this is online, obviously, but I think everyone, it's safe to assume most people have purchases higher than that amount.
Yeah, I would think so. It's still, it's interesting to sort of to see how companies are adjusting to the reality of this is a weakening consumer. Inflation is very high, and we need to have offerings such as Sam's Club, even though, like Matt said, you go into one of those stores, you're going to be spending money.
Right, it's another signal of that price pressure just staying on consumers.
Have you been yet to a Costco or a Sam's Club?
Don't start with me.
Coming up, we're going to hear the bull case from Marija Veitmane, head of equity research at State Street Global Markets. After we talk to Mike Wilson, the noted bear, we'll see what a bull has to say. This is Bloomberg. Just about 25 seconds until the opening bell here in New York City. We had yet again record highs in stocks on Friday, the 34th record high this year for the S&P 500 as the AI trade continues to fuel rallies. Meanwhile, calm has returned to European markets. A little bit of a worry yesterday that the far left winning in France would push deficits higher, but now it seems that the center can get a hold of things. In terms of what we see here on the floor of the New York Stock Exchange, Smurfit Westrock ringing the opening bell. Tony Smurfit, the CEO, is going to join us in just a moment after changing his listing from London to New York. So we got an Irishman here in New York. On the NASDAQ, we saw the U.S. soccer team ringing the bell, at least a couple players there. In terms of the futures, they are higher on the S&P right now, just about 0.1%. But every little helps. NASDAQ futures unchanged right now, and Russell 2000 futures really off to the races, up almost 1% on the small caps. Let's get over to Katie right now with some of the stocks to watch. Katie?
Well, one stock to watch at the opening bell, we have Morphic. Eli Lilly agreeing to buy the U.S. gut drug maker Morphic for about $3.2 billion. Of course, this is a core area for Eli Lilly. The CEO, Dave Ricks, he's promised more early stage deals to acquire new technologies. You look at how it's playing out, of course, in the first few seconds of trading. You can see Morphic up about 75%. And Eli Lilly, even though you typically see the acquirer fall, it's holding in there, up about 0.2% right now, Sonali.
I'm also keeping an eye, Katie, on Tesla because the EV maker is poised to snap an 8-session winning streak. Remember, just on Friday, you saw Tesla slip into green territory finally for the year, but you're seeing it down now about 1.4% on the day. Let's see if it holds, Matt.
All right, and Paramount, it's the end of the Redstone era as the media giant inks a deal with Skydance Media. It ends one of the messiest and most dramatic deals in recent history. For a closer look at Paramount, let's go over to Bloomberg's Abigail Doolittle. Abby, what do you got?
It really is pretty amazing. Deal on, deal off, and now the deal is official. But on this, we actually have the shares of Paramount at this point down about 1%. But this, of course, follows months of very complicated deal making because David Ellison Skydance has agreed to buy Paramount. They've been trying to do that for a while. So I should actually say Sherry Redstone has agreed to sell her family's National Amusements, which has a controlling stake in the shares of Paramount, really holding up that $8 billion deal. In fact, if we take a look at the voting picture for the Paramount shares, just that little sliver there, that orange sliver, that controls, so about 600 billion controls, 600 million of the stock voting shares, controls all of Paramount. She agreed to sell it for $2.4 billion. And now that they have agreed, David Ellison and a partner have agreed to buy Paramount, or National Amusements, I should say, that has this controlling stake in Paramount for $8 billion. There's hope that maybe MTV and CBS will be regenerated. But not everybody is surprised by this, Matt, because, again, it has been months of deal on, deal off, various deals. In fact, if we take a look at the stock over the last 12 days, we will see that even though the deal between David Ellison and Sherry Redstone broke down a few weeks ago, the stock up sharply over this time period, suggesting, well, some people not so surprised today. That could be, Katie, why the stock is down just a little bit today.
All right, Abigail Doolittle, thank you so much for that wrap up. And let's broaden out the conversation now to the wider stock market, because joining us now, I'm pleased to say, we have Marija Veitmane. She is head of equity research over at State Street Global Markets. And we were talking to Mike Wilson just a couple of minutes ago, and he told us that he wouldn't be surprised to see a 10% correction to the downside between now and, of course, the elections. Does that seem plausible by your math?
First of all, hello. Very good to be on the program. I would not be surprised to see some decline in S&P X technology. So that's where we're seeing weakness. That's where earnings are slowing. That's where kind of all the Fed and other central banks' effort to tighten policy are bearing fruit. However, we are still very, very optimistic about technology sector. We see earnings being strong. We see margins being resilient, and that's really giving the strength to the market. And one lesson we learned last year was that if tech is going up, the whole market is going up. So I think S&P X Tech, lots of concern for the whole market. Tech sector is going to support it.
Are these tech companies, Marija, these Magnificent Seven? Are they defensive stocks? Does it matter to them what the Fed does with rates? Does it matter to them if all the economic surprises come to the downside?
Yeah, and I think that's a really, really good point. And I think that's what AI has done for technology sector, AI excitement done for technology sector. We continue to see quite a strong revenue growth in technology sector because companies outside tech are really trying to figure out how to benefit, how to make money in with AI, and there are still continued investment in that theme. We're yet to see where the money ends. Is it software? Is it hardware? Is it chips? Is it something else? But money coming from outside tech into tech, and that's supporting the sector overall.
If we look at the concentration, like the breadth, Marija, that we've seen in this market, every time we have a big rally, we sometimes see only 150 or even fewer companies rising. Does that worry you that the breadth is so light?
I think it would worry me if there was just breadth in performance, but like lack of breadth in performance. But what we see, there is lack of breadth in earnings as well. So those technology companies are pretty much the only place where we see strong earnings growth, resilient margins. So what is happening in the market, and actually quite sensible. So investors are going for sectors, for stocks with better underlying fundamentals, which makes a lot of sense if you think that overall economic growth is slowing. So you should go into those quality companies.
But you like then individual stocks, and you don't have a bullish view on the broader market?
But I think that's the trick, because those companies we like in technology sector, they are really so big. So they probably going to pull the whole market kind of with them, pull them higher. But I would very much I would not at all expect the kind of the rally broadening to like small caps or value or cyclicals. That's not what we're saying. We're saying tech is strong. It will continue to be strong. There is momentum behind it, and it will pull the whole market.
Even if you believe that it could pull the market forward, do you get concerned, Marija, about valuations here? You think about just NVIDIA alone, finally getting some dispersion from the analyst community here. New Street Research with a downgrade, still they're an outlier. They're back on the rebound today after you saw UBS upgrade. Where do you stand in the valuation story?
I mean, no doubt that technology stocks are expensive. Or, well, they're trading at a premium to kind of historical multiples. But I think what matters at the current stage of the cycle, when earnings overall are slowing, economies is kind of getting weaker, and we can debate soft, hard landing, but it's getting weaker. You have to go and buy quality. You have to go and buy a better earnings story, more resilient margins. And oftentimes it's an expensive higher valuation. And that's what investors are doing. Investors do have large position in tech, and we see them adding to them.
And really quickly, before we let you go, I mean, you talk about the fundamentals here, and you think about the fact that we're skating into another earnings season. What's the most important metric that you're keeping an eye on? It seems like valuations maybe not the thing to look at, but for example, I've heard more of an increasing focus on cash flows, for example.
I mean, cash flow is super, super important. And again, tech is by far in a way the best performing sector. I'm very curious to look at corporate guidance. So we know that consensus expectations are for reacceleration of earnings growth in the second half of the year. And so far we heard from a few companies like Nike, FedEx. None of them are actually that optimistic. So to me, that would be interesting to see whether this consensus of reacceleration earnings growth in the second half can hold. And I'm a bit skeptical there.
Marija, great to get some time with you. Thanks so much for joining us on opening day. Marija Veitmane there, head of equity research over at State Street Global Markets. Coming up, we're going to speak to one of the leaders behind the world's largest hedge fund. Greg Jensen, co-CIO at Bridgewater Associates, joins us. We're going to talk to him obviously about markets, also about politics, but especially about AI, artificial intelligence and machine learning. This is Bloomberg.
This is Bloomberg Open Interest. I'm Abigail Doolittle. You're looking at a live shot of the principal room. Coming up, Howard Marks, Oaktree Capital co-founder, joins us next hour in an exclusive interview at 10 a.m. New York time. This is Bloomberg.
All right, let's get to our top calls. Some of the analyst action in focus this morning. And first up, we have UBS raising its price target on NVIDIA to $150 and keeping a buy rating on the shares. Now, the analyst cites robust demand for its AI chips, and that follows on Friday a rare downgrade for the chipmaker by New Street on valuation concerns. Next up, we have Raymond James upgrading Gilead Sciences to outperform thanks to potential growth in its HIV and liver disease treatments. And finally, we have Guggenheim cutting ServiceNow to a sell. The analyst says that the software company's valuation doesn't match its future risk. Sonali.
And we're going to switch gears. We're going to talk about Bridgewater. The world's largest hedge fund is on the rebound. The pure alpha strategy, very highly watched, is up 18% through June after a weak 2023. That's all according to people familiar with the matter. Bridgewater is also plowing into the high-flying world of artificial intelligence. Joining us now to talk about it more is Greg Jensen, the co-chief investment officer at Bridgewater Associates. And Greg, talking about, the performance at Bridgewater has clearly been up double digits this year. What is happening that's going right? What are the bets that you guys made off that you are seeing now play into 2024?
Well, I think Bridgewater can benefit in multiple ways. The basic idea of pure alpha is that for over 40 years, we've built up our understanding of how macro developments impact markets. And we continue to improve that process, but there's been so many things, as you guys are talking about here, so many major macro events going on this year that have pressured markets. The fact that the Fed had to tighten slower than it expected to at the beginning of the year, the ripple that had through the fact that U.S. growth has been generally resilient, all of those pressures add up to opportunities for us, and particularly differential pressures across countries. After the tightening cycle was very global, the impact of that tightening cycle across the world has been quite different. creating a tremendous amount of opportunities for a strategy like Pure Alpha.
What do you expect going forward? I was watching last night in preparation a panel you did at Davos, which was back in January. You were skeptical that we'd get 6 cuts this year, and at that time, the market was pricing that in. Now, we're only looking at 2, maybe 1, and yet the market is up, 15%. What's driving that, and can it continue going forward?
Yeah, well, when you talk about the equity market, I think the biggest question, right, the thing that reconciles the circle between the interest rate market and the equity market is productivity. Is there going to be a major productivity effect of the new technologies, machine learning, et cetera, coming through? Because you need it, really, to reconcile the level of the stock market. The expectation for earnings going forward are quite high. At the same time, the expectation in the interest rate market is that the central bank will be able to cut rates, that services inflation will continue to come down. So you need this kind of perfect situation of earnings staying strong, demand staying strong enough to make those earnings strong without keeping inflation above the Fed's target. How do you get there? You've got to get there through higher productivity. So that's the big question, is how much productivity, when will it occur? Because to reconcile the markets, you need a pretty big jump in productivity to allow higher earnings and lower inflation.
Well, I definitely want to get to machine learning, but before we do that, let's wrap in Fed risk and political risk into one question, because I was reading a note from Goldman saying that the risk of Trump being reelected and putting in place some of those tariffs that he's talked about, it could lead to 5 extra Fed hikes. So not talking about cuts there. And when you think about all the known unknowns that are out there, especially as it relates to politics right now, are you hedging for any risk of something like that scenario playing out?
Yeah, I think you have to be really thoughtful because there's so much political risk going on. And the shift generally you're seeing across the world is kind of dissatisfaction with the people in power, populism in many cases continuing to be on the rise. And a Trump versus Biden or Trump versus whoever the Democratic nominee ends up being is very significant change in policy. One of the more significant elections. It'll probably happen very quickly, just like there was the significant corporate tax cut when Trump came in before. He's coming in ready with tariffs. That's the big first thing. The second thing will be the continuation of the tax cuts. All of this move towards populism is pointing towards a continuation of more government deficits, probably more inflation, tariffs, at least in the short run and probably in the long run. Our view would be that they're inflationary. And a Trump presidency, the thing that we'd kind of most be concerned about is the long end of the rate curve. Probably bond yields, Fed, they'll try to get an easy Fed in and probably have the most significant challenges on the long end of the yield curve in terms of bonds. But those policy changes are going to be significant. And if you look at basically just understanding global macroeconomics today versus 25 years ago, understanding government interaction with markets has become so critical.
Right. How do you then position, if you believe inflation is in the future, do you go short the long end of the curve, and do you do it significantly?
Well, we try to take a diversified set of positions so that no one position can be too dominant in our portfolio. But it's tricky, right? The long end of the yield curve, a lot's going to depend on politics, right? And a lot's going to depend on how unified the government is. Will Trump be able to get everything he wants, or if the Democrats are elected, will they be able to get everything they want? Divided government will generally be good for bonds, and a unified government, one way or the other, Republican or Democrat, would probably be bad. Anytime these governments are unified right now, you're seeing movements towards populism, movements toward bigger deficit spending. And we think that's the more likely outcome, is that you continue down that path. But there's a lot of change along the way. And in the short run, what's going to matter is Fed policy. And is the Fed constrained? We think the Fed's itching to ease. They want to essentially have the stats come in a way that allows them to, and we're close to that. They probably
need to, right? With $100 billion plus of debt servicing costs every month, we need rates to be lower. At what point does, and I know we want to get to AI and machine learning, I want to get there as well, but at what point does this massive debt and the servicing costs really start to become a problem for, the 10-year yield or the strength of the dollar?
Well, and that's what I think we're going to find out, right? What you can see right now is there's not much risk premium in long duration bonds. There hasn't been a problem. That doesn't mean there won't be, right? And I think the main thing I'd say is the destiny here is that governments are going to push until we hit the limits, right? You see that in countries like Brazil or whatever, where they're at the point where fiscal spending hits the limits. You saw that for a brief moment in 2022 with the UK.
The Liz Truss moment.
Liz Truss moment. But in the US, you're still probably a ways away. But I think the destiny of it, because of the populism and sort of the amount of things that need to be fixed in the US, the likelihood is we find that. Now, I would guess that's a couple years away, but that we'll continue to press in the direction until we find the limit, that easing fiscally will continue to be the path until that limit is hit.
Until the bond vigilantes come back.
Yeah, and it won't be, speculators are too small relative to what's going on. It's really the Fed and and generally the size of that issuance. And so what is going to be the limit is inflation. If there's no inflation problem, there won't be a problem for bonds. It won't come from anything other than inflation currency problem.
I want to talk about something people are really excited about. That's artificial intelligence. Greg, we recently reported that just about exactly a week ago, Bridgewater started its own AI strategy in a new format here, a new fund format. But also, you were an early investor in OpenAI, in Anthropic. How do you think about investing in AI at Bridgewater? Do you buy into those high-flying names, or are you better off doing it in the private names personally, given where valuations are today?
Yeah, well, I'd say when we think about it from a pure alpha perspective, most of what we built up at Bridgewater is an expert system based on everything we've learned over the 40 years, mainly on how economic cycles work. And big productivity miracles are pretty separate from economic cycles. So when you look at what we're doing in pure alpha, we're generally trying to make sure we don't have too much exposure to whether the productivity miracle works out or not. So when we trade U.S. equities, we trade them kind of with AI hedged, because the pressures, the normal cyclical pressures will play out on the regular companies. And when you look at U.S. stocks, it's kind of the regular companies that we'd say are pretty expensive relative to the rest of the world. Mediocre companies in the U.S. have a U.S. premium in them relative to the rest of the world. Now, the great companies in the U.S. are the companies hitting the cutting edge. That's a different story. And it's very different than 1999, 2000. I've been at Bridgewater for 29 years and having lived through 99, 2000. That bubble was all about future expectations. Most of what's priced into equities today actually would say are based on what's happening right now. I mean, what's happening with NVIDIA's demand is incredible. And whether it's slightly overpriced or slightly underpriced or whatever, it's a close call. This is not like the 99 bubble, at least in my view, because the earnings for those companies are actually there in a way they weren't there for a company like Cisco in 1999. So there is a big difference. Now, you still need those earnings to be sustainable, which requires a continued growth in those areas, but not an outlandish one. And that really comes to what internally. So we need to understand AI from a macro perspective, and then we need to understand it as a user, a micro perspective, right? That in our IA Labs, which is 25 people we set aside at Bridgewater, fully focused on using machine learning for everything you need to do to invest in markets, that group, we're hands-on. We see both the problems. There are many problems. The language models off the shelf have many problems with them. But if you can combine them with data models, you can create this incredible strength. And right now, I expect over the next 5 years, so much of what human investors and analysts can do can be better done with machine intelligence. So that's been a journey for me. I've been looking at this for, Bridgewater's built an expert system based on human intuition being translated into algorithms.
Right.
For AI, having machine learning generate the ideas, generate the algorithms. That's been kind of a dream for me. And the technologies really came together in 2022 or so, that the pieces came together such that I thought we were ready to build an artificial investor. And we've moved down that track at rapid rate.
Greg, thank you so much for giving us a preview on this new strategy over at Bridgewater. And of course, the view of a very complicated markets. Of course, that is Greg Jensen, CIO at Bridgewater Associates, co-CIO. Now, coming up next, the market moving events you need to be watching this week. There are a lot of them. That's next in our trading diary, coming up next. This is Bloomberg.
Let's get to the trading diary, what you need to be watching this week. We get the New York Fed inflation expectations at 11 a.m. today. Powell will deliver his semi-annual testimony on Capitol Hill starting tomorrow and go further with that on Wednesday. On Thursday, we get CPI, so more inflation data. And then on Friday, JP Morgan, Wells Fargo, and Citi will kick off earnings season. We're here to cover it all for you. Coming up in the next hour, investment guru Howard Marks of Oaktree Capital. And in today's C-Suite Conversations, Anthony Smurfit, the CEO of Smurfit Westrock, joins us, one of the world's largest packaging companies, plus the CEO of Lambo. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, investors are gearing up for a host of risk events, from Powell's testimony to earnings season.
Investment guru Howard Marks sees a sea change underway in markets. He tells us why in just a few minutes.
And the view from the C-suite. We'll speak with the CEO of Smurfit Westrock, one of the world's largest packaging companies, plus the CEO of Lamborghini. Before we get there, let's get a check on these markets right now. You can see the S&P 500 currently at record highs, up about 0.2%, actually outpacing the NASDAQ 100. Big tech, I'm going to go ahead and call that unchanged on the day. It's the same thing, too, if you take a look at the bond market, taking a little bit of a breather right now. The 10-year Treasury yield currently unchanged, Matt.
Yeah, great to launch this show on this day, because if you'd said previously you're going to launch on July 8th, I would have thought not much going on.
Tough sell.
Amazing the amount of risk events that we're launching around.
In addition to Jay Powell this week speaking to Congress for hours, you also have CPI after we saw a weakening of the labor market here. So a lot on the line.
Plus the elections, right?
Plus Jerome Powell.
Yeah, so much going on. In fact, let's focus in on election risk right now. Turn to Europe, where we've seen real political upheaval in the last couple of days. In the UK, Labour wins a landslide victory, ending 14 years of Conservative government. A surprise victory for the left in France, leaving Le Pen in third place when we thought she'd be leading. Meanwhile, here in the U.S., President Biden just came out with a 2-page letter addressed to Democratic lawmakers saying he will remain in the 2024 presidential race amid calls for him to stand down. Joining us to help make sense of it all is Bloomberg News editor-in-chief John Micklethwait. John, great to have you on the program on our launch day. Thanks for joining us. Let me get first your take on the UK. I mean, it's hard to overstate what an incredible shift this is, and yet Keir Starmer isn't the left-leaning Labour leader that we've seen in the past.
Well, firstly, what an honour to be on the first thing of open interest. I mean, obviously, mainly Katie and Sonali, but also you, Matt. In terms of Britain, I think it's actually quite interesting. You have this rather boring man, Keir Starmer. As you point out, there isn't a lot of policy difference between him and the Tories coming into this. But he has, to some extent, hit the ground running. And he is also a bit like one of those people who suddenly won the lottery a bit. He has arrived just at the time that every other major leader seems to be in a lot of trouble. You can look at what you mentioned, Macron. Macron has ended up with an election result which was less bad than many people feared, but still pretty awful compared with how it looked a couple of months ago. You've got Joe Biden trying to hang on to his job. You've got Olaf Scholz not in a great state. There's a whole host of things where Starmer looks a slightly bigger, more impressive figure on the international stage than many of us either dared hope or dared fear.
And it's interesting, of course, that international stage, in some ways it looks different, but it's all coming to NATO this week. You're going to have Starmer there, you're going to have Macron there, obviously you're going to have Biden there. It's an interesting confluence of all of these political risks that we've been talking about in one place, John.
Yes, totally. I mean, if you look, you're going to have already, you can see all the attention on every single thing that Joe Biden does in any way. And this letter is the latest attempt to try and staunch that particular wound. We'll see whether it works or not. But you've also, Macron's going to show up to some extent, sort of not looking at his best, because he'll probably have to deal with a very left-wing prime minister. he's already in difficulties. You've got other people jumping around the place. And so I think it will be a very, very different NATO than one might have imagined. And behind it, you have the big issue of Ukraine. You know, I think Starmer is pretty solid on Ukraine. I think that Macron is and Joe Biden is. But Macron may have to deal with a prime minister who is less solid on Ukraine. And Joe Biden may not be there for a long time. So this is all rather difficult from the point of view of what we used to think about as the West. And it's hard to believe that all these things don't at some point have an impact on markets. They may be good. I think there are a lot of reasons why business and markets might actually strangely look on the Starmer prime ministership here as a good thing. It's quite difficult to see anything good in terms of a much more left-wing, wealth tax orientated government in France. And Joe Biden, you know, the basic question is, do you end up with somebody who might be better than him or worse?
John, if you think about what's happening in France with the far right and the far left really closing in even further on the center, how do you think about that in terms of what there might be to be learned in the United States, which is facing somewhat of a similar dynamic?
I think that the answer is that at the moment, people are not in love with incumbents. I think that's a very straightforward question. And secondly, that there is a value in, how can I describe it, as brutal decisions and getting on with it. I mean, Starmer is characterized by nothing else with simply trying to position himself as emphatically as possible in one place. I think there is some evidence at the moment that if you are a kind of technocrat who looks as if they are competent and knows what they're doing, yes, you do stand a chance. You know, Starmer is one example. You can also say Greece, another example. You know, part of the problem with Macron is he doesn't look as competent as he used to. Olaf Scholz in Germany has always had problems in that regard. So if you transfer all those arguments to America, you know, there is still, I think, a coalition of people who could be brought together against, say, Donald Trump. And the question is whether Joe Biden is the person who's able to bring that collection of people together.
John, thanks so much for joining us. Bloomberg's editor-in-chief, John Micklethwait, coming to us out of London after a number of elections in Europe, two big ones in Europe. And, of course, the political story here is fascinating to watch as you have a president, an incumbent, who says, hey, look at my record, I've done well. And yet a lot of his colleagues, a lot of his fellow party members are worried about the future.
You know, Katie's been asking this great question all day, which is when do you start timing election risk? When do you start putting chips on the table in stock and bond markets, knowing how much uncertainty there is still? Think about it in the U.S. from now until November.
Yeah, absolutely. You think about what happened last week. Of course, in the wake of the debate, everyone was saying that it would be the bank stocks that outperform. You didn't see that. You saw yields reverse. And of course, the dollar fell as well. So that Trump trade, it quickly fell apart.
It quickly fell apart. And you have to wonder also how much the fiscal situation in these companies are going to start to impact the monetary policy. And of course,
in these countries.
In these countries.
Yeah.
In these countries. And of course, in the markets alone as well. Of course, now we are going to talk about that very soon with a lot of our guests throughout the week. We have Torsten Slok tomorrow before Powell. And just ahead of us now, we are going to bring in just the right guest for this conversation. We have somebody who has been studying these markets for a very long time. Of course, we are going to now bring in our Bloomberg television and radio audiences because, of course, as we've been talking about, that mounting concern about how big government spending has going to create this issue here to markets, potentially upending them, making the job more challenging for central banks. Of course, as Jerome Powell, the Fed chair, has 2 days of testimony ahead in Congress, all in the middle of a weakening labor market here in the United States. It's the perfect storm. We are now joined by Oaktree Capital Management co-founder and co-chairman Howard Marks to talk all about it. We've been talking about the fiscal issues, right? We've been talking about the monetary conundrum that's been happening for now well over a year for the Fed chair. If you think about the potential for fiscal to really upend how investors think these days, how much is the government debt loads in the U.S. and abroad really changing the calculus?
Well, look, Sonali, I think it's unfortunate that the U.S. behaves like a country that has a credit card with no credit limit where the bill never comes. I mean, nobody can think that's a good idea. you would think that there has to be a point at which our debt or our deficits become too much, reckoned as a percentage of GDP usually. Nobody will tell you that point doesn't exist. Nobody will tell you where it is. Nobody's exercising fiscal discipline in Washington these days. Last year we had a deficit in the trillions in a period of prosperity. Not supposed to happen. All very unfortunate, but A, nobody can tell you when it becomes a problem, and B, nobody can tell you what to do about it. You can't eliminate the U.S. from your portfolios. People who've said to do that in past years are now looking pretty bad.
Yeah, I was going to say, if you had followed that advice, you'd be in a world of hurt right now in terms of relative performance. And you said that no one can tell you where that point is, but that's exactly what I'm going to ask you. Where do you think that point is? Is it something that we're approaching if you don't want to exactly pinpoint it? I
don't want to exactly pinpoint it. I want to say that I'm among the people who can't tell you where it is.
Fair enough.
One of the many.
Yeah, I think every time I come on this on Bloomberg, I quote Mark Twain, who said, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true." I certainly don't know.
I wonder what kind of opportunities you're finding. I'm always interested on the distress side about how sort of target-rich the environment is. I think that says a lot about our economy. All the economic surprises that we see are to the downside lately, and rates remain high. Does that make this interesting for you?
Well, I think it is interesting. I mean, we went through a really slow period from 2009, when the Fed took the Fed funds rate to 0 to stimulate the economy, to 21, when they decided to lift it to fight inflation. And in that 13-year period, there was very little distress because it was a very benign environment for companies. Now, as you note, interest rates are higher. That gives us more of an opportunity. And importantly, there were a lot of leveraged transactions done in the period I described, where companies were burdened with capital structures, debt structures, that did not anticipate a 500 basis point or 400 basis point increase in rates. So, to put it in short, it was a great time to be a borrower because rates came down and business was prosperous. But right now, and I think going into the future, leveraged companies will not be able to renew their leverage as easily, and the cost of doing so will be higher. So that gives us better opportunities than we've been seeing. And just to put it in brief for your listeners, 6 years ago, you had an idea, you went into the bank, you described it, they said, fine, we'll give you $900 million at 5%. Now it's time to renew your debt. You go in, you describe it again, and they say, good, we'll give you $500 million at 9%.
Yeah.
Where do you think most of that pain is going to come? Because there's the private equity universe that's clearly grappling with that refinancing pain. There's the commercial real estate market. And equity investors seem to be ignoring any leverage that might be under the system still. What should they be watching out for?
Well, clearly, Sonali, it'll be in highly levered situations, and you name two of them, private equity and real estate. Leverage, the use of debt to amplify your returns, it has been the lifeblood of these two asset classes, and they've done extremely well as a result. It was very, very salutary for them, but that's where the pain will come in the future. You can't increase a company's debt service cost markedly without affecting its returns. And in certain sectors of the real estate world, mainly retail and office, there are fundamental questions. So you put that together, we think you'll see some disruption, which will give us and people like us opportunity. This has been a really tough period for lenders, which is what we are, and a really tough period for bargain hunters.
Right. Well, I want to talk a bit more about the business of lending and what's going on in the private credit industry. Of course, a month or two ago, we saw Pluralsight, backed by Vista, basically transfer its assets into a different subsidiary to obtain more financing from its sponsor. That's become a little bit of a battle cry. You see lenders basically asking for Pluralsight protection right now. I won't ask you specifically about what happened with that episode, but how do you see this evolving in the industry? Do you think that we're going to see more creditor-on-creditor violence, as some have been calling it?
Well, people tend to do what they can to enhance their position financially. Most people will stick to what they can do legally. Some people will stick to what they can do ethically. There's some question about what that means. But people, if there's an opening, people will take it for the most part. And there is an opening for what you call creditor-on-creditor violence. That is proactive efforts to enhance your situation financially at the expense of somebody else. And the important point is that it's up to lenders to study the documentation well enough to prevent it. That's it.
Are you active in office space right now? Because it seems like the perfect storm for anybody who has the financing. We talked to Yigal Namdar, a real estate investor, a couple of days ago, who is getting like 70% off really big, important office buildings in New York, the capital of the world. Like, how can that not come back?
Well, the question, Matt, is very simple. Let's say you're getting 70 off. Is that enough? And the mere fact that the price of something is down doesn't make it a buy. It has to be that the price is down more than it should be, given the fundamentals. And, I think it's going to be up to the experts, people who've made their life in that world and with success, to make that assessment. I think that if there is a bunch of real estate funds formed this year, somebody who puts all their money into office and somebody who puts none of their money into office, one of them will be the best performer. I just don't know which one.
If you have these struggles that are still under the surface, we are just about, 5 days away, really, from bank earnings. And the question is we enter this era where they're about to meet new capital rules as well. Mm-hmm. Are there still just tremendous stresses under the system that people are not noticing?
Well, it's the small to mid-sized banks, the community and regional banks that are heavily weighted toward real estate loans. The biggest banks, over $250 billion in assets, don't have much of a concentration. They're not at risk. But some of the smaller banks, I think on average the banks under $250 billion in assets, loans on real estate make up 160% of their regulatory capital. So some of them will find pain, especially the ones who lent above average and concentrated in regions that are troubled and so forth. So, I don't think it's a systemic risk that's going to put us in the sink, but I do think that you'll see some companies in trouble. And, one by one, the authorities may have to bail them out and may well do so.
All right, Howard, unfortunately, we have to leave it there. Great to have you, of course, on our launch day. Our big thanks, of course, to Howard Marks. He is the co-founder and co-chairman of Oaktree Capital. Now, coming up on this program, we have packaging giant Smurfit Westrock making the move to Wall Street. We'll speak to the CEO next. This is Bloomberg. Well, one of the world's largest packaging companies is making its debut on the New York Stock Exchange today under the ticker SW. And joining us now, I'm pleased to say, from the floor of the NYSE, we have Tony Smurfit. He is the CEO of Smurfit Westrock. So this acquisition, you bought U.S.-based Westrock for $11.2 billion in September. Westrock being U.S.-based, of course. But why are you moving your primary listing from Europe over to New York?
Hi, Katie, and congratulations on the new show. We're both making our debut today. The reason we have with the acquisition or with the combination of Westrock and Smurfit Kappa, we have about 70% of our business over in the Americas. And so, our stakeholders, our shareholders would prefer to see us being on the largest, most liquid exchange in the world. And so that's the reason why, logically, we moved it here. And I think it's been very well received. We've immediately gone into the S&P 500. And I think that's going to be good for us long term as we develop the company and put the company together and grow the company to be the kind of company I think we can be as one of the great companies of the world.
Tony, I'm curious if you have any numbers here. If you're listed in the United States, of course, the deepest capital markets, as you've been saying, you're added to an index here. What does it mean for how much more investor interest you can draw, and therefore what that means in terms of what you could do with that additional capital access?
Well, I think what we've got here in the United States is the first thing that we're really focused on is getting the combination together, working well. And then, obviously, the thing to do is to move our business forward in a very progressive manner, either through acquisition or investing in the business to grow the business and make sure that we take advantage of the huge opportunities we've got. We're in sustainable packaging. Sustainable packaging is the go-to business, the go-to packaging of the world. It's not fossil-based. And I think that we're the right product at the right time and in the right environment. And so we believe that investors will be attracted to that here in the United States, around the world, of course, but here in the United States. And that will obviously, hopefully, drive the multiple of the company and drive the share price of the company so that all of our stakeholders are rewarded.
And of course, you follow the likes of CRH, Flutter, for example, also making a similar move. So interesting to see this growing trend. I do want to talk about this specific combination, though. Smurfit, of course, with Westrock. If you take a look at Westrock's operating performance, it's actually lagged that of Smurfit. So what are the steps that you have in place and you plan to take to close that gap? And over what time frame could that play out?
Well, we put Smurfit and Kappa together back in 2005, so 19 years ago, and we built it brick by brick. And, it takes a while, but clearly, we've got a wonderful culture within Smurfit Kappa, which I really feel proud of. And, the Westrock people are really great people, and I think what we can do is help bring them into the fold, so to speak, and take the best of them and the best of us, and putting them together with all the innovation that we do. I mean, we've over 1,500 designers across the world in 40 different countries, making sure that we can give all of our 100,000 customers worldwide, the best packaging, and not only the most sustainable packaging, not only the most innovative packaging, but the packaging that's fit for purpose. I think it's interesting to remember that during the pandemic time, we were deemed an essential industry. Without our product, corrugated boxes, many products wouldn't have got to the shelves. So we are an essential business. We're all around everywhere. You know yourself when you were getting your e-commerce deliveries, it was all in corrugated boxes. And I think when you look at how people look at companies like Smurfit Westrock, I think you should invest in companies that really you can see around you and that are well managed. And my job as CEO of this company that I've been really honored to lead is to make sure that we steer this company in the right direction so that we get paid for what we do and make sure that we enhance the margins. And we've done that in Smurfit Kappa over many years, and I think we can do the same with Smurfit Westrock.
Tony, I'm really curious. That's a real nod also to your connection to the real economy. And a lot of investors are starting to weigh the possibility of a soft landing or even something harder if things don't go to plan. How are you preparing for any scenario at this point?
I think at the end of the day, Katie, or Sonali, I don't know who asked the question there, but I think at the end of the day, when you look at the corrugated box, it is ubiquitous. It is fit for purpose. And so whether or not the consumer is a little bit buying a little bit more, a little bit less, they still have to eat. 75% of our business is in food and food-related things. And so really, for us, obviously the cherry on the cake is when we have higher housing starts and things like that. But when you look at the base of our business, it's in food and consumables that people have to have. So I think it's a very, very solid company, solid area to be in business. Right. And add on top of that the whole sustainability agenda and the innovation that we can bring to our customers.
All right, in less than a minute, I do want to talk about the packaging business as a whole, because it is an industry that you've seen a lot of consolidation. You have this deal, you also have Sonoco buying Evios, and then you had International Paper agreeing to buy DS Smith earlier. Do you see more of these type of deals coming through when it comes to the packaging industry?
I think there are three pretty big deals. I mean, we obviously led the consolidation trend. I think there will obviously be more because there are a few other players out there that could be looked at over time. But I think consolidation is is always going to happen in our business, because putting companies together makes sense if you can bring the cultures together. And I think we in Smurfit Kappa and now Smurfit Westrock have proved that we're able to do that, and that's why I think we've got a very exciting future.
Our thanks to Smurfit Westrock CEO Tony Smurfit for joining us, of course, down at the New York Stock Exchange. We appreciate your time. Now, coming up, the luxury consumer is still stepping on the gas pedal. We're going to speak to the CEO of Lamborghini, of course, the chairman as well, joining us next. Stick with us. This is Bloomberg.
All right, the wealthiest people in the world are still driving in the lane of luxury. Lamborghini posting a record-breaking 2023 and the momentum powering on through this year. The automaker is planning to roll out new models in 2024, including a hybrid vehicle as well as a new twin-turbo V8 model to replace the outgoing V10 in the Huracan. Joining us now is Stephan Winkelmann, Lamborghini's chairman and CEO. Stephan, great to have you on the program. I got to ask first about the successor to the Huracan, because I was able to get some seat time in that car, and it's the first vehicle in a long time that's brought actual tears to my eyes. It was so good to drive in the Sterrato format. What's coming next?
Next is, let's say, the closing of the first part of our strategy, now the Direzione Cortauri. We started last year with the Revuelto as our V12 with a plug-in hybrid. Earlier this year, we showcased the Urus SE, and now it will be the third one. So the follow of the Huracan will be completely new. And this is going to be the third car with a plug-in hybrid system. And it has an incredible engine, which is revving up to 10,000 RPM. And combined with the battery solution, we are heading at the launch already to 920 horsepower. Something really exciting, and we call it a 40 class. So somebody who's really playing in a different field, much better than all what has been seen so far in this field.
Stephan, I get the hybrids. For supercars, it just makes sense because you get the instant torque of the electric motor, plus the feeling, the vibes, the smell, the sounds, the character of the internal combustion engine. But how do you expect to see these cars resell? Normally if Lambo sells a vehicle for, say, $300,000, it goes on the secondary market for $400,000. Like, they command instantly a premium. But we haven't seen that with, for example, Ferrari's hybrids. They're the first cars that company puts out that actually fall in the aftermarket. So what do you expect for the plug-in hybrids in terms of resale value?
So first of all, you have to keep the promise. The first promise we are making is to be more performing and more sustainable. The second one is that the car always has to be a complete new car in terms of design. These are the two things, so design and performance, including better sustainability. Then, for sure, the big risk is always that you get too excited, that you produce too many cars, and therefore the residuals are going down. This is a mistake which we are not going to do, so we will leverage very much on the length of the order bank and balance accordingly. So today, if you buy a Lamborghini, our cars are always more expensive than the ones, the used ones in comparison of the new ones. It's clear that we are experiencing now, let's say, a new generation. We always said we don't need to be the first ones on the market with new technology like this, but we have to get there when we are safe and we are sure that this is going to be a success story.
And of course,
so far there is nothing playing against it, and therefore I don't have any, how can I say, news about a negative impact.
So to talk a little bit more about fully electric vehicles, you're in no rush to get there. Like you said, you want to do it right when you do get there. But I want to talk about why the delay. What else you're waiting to see? Is it performance? Is it concerns around demand for fully electric supercars? Or is it more of those emotional aspects that Matt was talking about, such as the sound of the engine?
But for sure, when we speak about full electric cars, if it's about performance, we are already there. This is not the big thing. Where I think we have to be patient is the fact that we say, once we speak about performance, there are two ways into looking into it. One is the pure numbers, so acceleration, top speed, time of braking, and lap time. And the other one, which is the emotional part, is how you feel the car. And how you feel the car is the responsiveness of the car, the lightness of the car. And this, in my opinion, is still something where we have space for improvement, and we will showcase this in the years to come. And therefore, we also said we will have a split approach for the two super sports cars, like the Revuelto and the follow of the Huracan. We will go as long as we can hybrid, also if feasible after 2035. And for the more daily usable car, like the Urus or the fourth model we are planning to do, there we are inclined to say that these could be then the first full electric cars, because they're daily usable. They're not only a racetrack car or weekend cars, and therefore the balance between performance and also sustainability and the acceptance is going to be there earlier than on the pure super sports cars. And on top of that, it's clear that we have to, because you were referring to the sound, we have to see how to create a sound which is not for sure mocking the internal combustion engine, but it has to be a specific sound, and we're working on it. And in my opinion, we will come up with very clever solutions.
So there will be a sound there. And I do want to talk a little bit more about the expanding lineup. It didn't make me cry like it did with Matt, but it is exciting to see you, of course, expand the portfolio. You think about the 2023 that Lamborghini had, of course, sales passing 10,000 units for the first time ever. Do you have a specific target in mind for how big sales could get, such as 11,000, 12,000? Are you looking at any specific number there?
We're always looking at exclusivity. So for us, it's important to have a clear idea of the length of the order banks in front of us, which is, as I said, approximately 2 years. So this is a good length. And if it's about exclusivity, then if you compare, a total market is around 75 plus million cars registered every year. And if we are registering 10 or 11 or 12,000, this is not making any difference in terms of visibility of our cars globally. So we will accord or adjust accordingly to, let's say, the willingness of the size of the segment and the amount of people willing to buy cars like ours. This is something which we are, let's say, controlling very closely in the big areas of this world. If it's North America, Europe, of Asia or Asia Pacific, we are very much cautious on not overdoing it and always looking at the value of the used cars.
Stephan, I think this is the million-dollar question here. Matt has pointed out to us previously that luxury car makers have commanded a significant premium when you look at how they're trading in public markets, and it really raises the question, given Lamborghini's status, would you at some point in the near future consider a listing of your own to be a standalone entity in public markets?
No, I'm being asked this every time, so I appreciate, but there is no idea to get listed.
What about racing, Stephan? I mean, Audi is your parent company and going to be involved in F1 next year. Is Lamborghini going to be able to get any involvement in that? Because it's a pretty sweet area in terms of, you know, publicity, marketing, sales.
I have to tell you, no, Formula One for sure is a championship or race type, which is very interesting, but it's not for us. We have a clear strategy. We started with one make race series, then we got into a GT3. Now we are in LMDH. This is hypercar endurance racing, which is big. We have a visibility worldwide, and this is very much enough for the size of our company. We have a Skoda Corsa, so a motorsport environment, which is not that big, but we are going strong, and we will stay there also in the years to come. And I'm sure that we will be better each and every year.
All right.
But no Formula One is...
Stephan, unfortunately, we have to leave it there. Really appreciate your time today on our launch day. Our thanks to, of course, the CEO of Lamborghini, Stephan Winkelmann. Let's get a check on these markets right now. We're going to do that with Bloomberg's Abigail Doolittle.
We're looking at a small gain for the S&P 500 right now, Katie, but if the gains do hold into the close, it will be the 35th record closing high of this year. Now, something interesting is happening beneath the surface, and you can see with the stocks up 1.2%, at the highs up closer to 2%, heading to, at that point, its best day in about 3 weeks, maybe even a little bit more than that. Beneath the surface, you have Apple and some of the other big tech names, such as Meta and I believe Microsoft, lower, but on the other side of the scale, you have Nvidia higher. So that's why the S&P 500 is trying to hang on to this small gain. The NASDAQ 100 has been flipping between gains and losses, taking or turning it to a little bit of a risk-off tone. Take a look at the Bloomberg Commodity Index, down about 1% or so. This as oil, metals, grains all lower. And then we also have Bitcoin down, plunging, in fact, right now down 2.6%, well below a key technical level. In fact, let's put this into the perspective of a chart that suggests that the losses for Bitcoin may continue. If you use Bitcoin as a tell on, risk off, this chart may suggest that there's some risk off ahead as we go into earnings and, of course, the July Fed meeting. But you see here Bitcoin over the last several years coming out of 2016. This is essentially its uptrend, very volatile, not for the faint of heart. We also can see that the RSI here on this weekly chart coming out of overbought territory, going down, telling you that the momentum is very much to the downside, and Bitcoin coming off of that high, heading, it looks like, toward that long-term uptrend at, let's call it 40,000 or so. Let's stay tuned. I was just mentioning the earnings season, and the next couple of weeks, of course, it kicks off with the big banks. But this week, $1.5 trillion, so a relatively small earnings season by market cap. Next week, closer to $5 trillion. But then July 22nd and July 29th, well, those 2 weeks, Katie, those are, of course, when all of your mega cap tech names really report, and 15 trillion and 15 trillion, a little more, a little bit less, but lots of companies reporting in the weeks ahead. Stay tuned.
Yeah, a lot to look forward to there. Our thanks to Bloomberg's Abigail Doolittle. Now, coming up, a surprising result in France's election. We'll discuss the implications with Michael Froman. He is Counsel on Foreign Relations President. That's next. This is Bloomberg.
This is Bloomberg Markets. I'm Abigail Doolittle. You're looking at a live shot of the principal room. Coming up, Seema Shah, Principal Global Investors Chief Global Strategist, joins Bloomberg Technology at 11 a.m. New York time. This is Bloomberg.
Well, it's time now for our daily Wall Street Week conversation. And today, we're focusing on the French elections. And here to help us analyze the unexpected defeat of Le Pen's far-right movement, I'm pleased to say we have Michael Froman. He is Counsel on Foreign Relations President, and of course, Wall Street Week's David Westin. And surprising is one way to describe it.
Yeah, exactly. Certainly surprising for Marine Le Pen, and maybe for a lot of the rest of us. But there have been so many surprises recently, Katie. I don't know where to start, but let's start with France. Mr. Ambassador, thank you so much for being here.
Thanks for having me.
It was a surprise, but right now, and we'll see how it plays out, it looks like a bit of gridlock, because nobody has a majority there. If there is gridlock in the parliament over there, what does that mean for their economic policies?
Well, first, I think President Macron took a big bet, and took a bet that the French people would not want to see the far right in power. And to that degree, his bet paid off. And in the second round, the French people showed up, they voted, and they voted more for the far left than they did for the far right. The problem is they didn't really vote for President Macron and his centrist coalition. So the question is, as you said, David, how does he govern from here? Can he come up with a coalition that is really capable of governing France? And who will that be with? Will it be with the socialists? Will it be with the far left? Will it be with other centrist parties? It's really unclear at this moment. And as you say, there's gridlock. This will be a process that plays out over the next several weeks. One thing's clear is that assuming the far left plays a significant role going forward, there's likely to be more pressure for spending, for higher spending, less interest in the kind of economic reform reforms that President Macron has been pursuing to make France more competitive, more productive, to get on a higher growth trajectory, because France, like the rest of Europe, has a serious growth problem, and that issue is going to likely not be able to be addressed in the context of some type of cohabitation, as they call it, between a president of one party and a government of another.
When you take a look at how markets are reaction, it's been a little bit muted, of course, because we've been talking about that gridlock, and there's the thought there that basically that gridlock is going to prevent maybe some of the most ambitious spending plans from the left from coming through. I mean, how much of a brake check is that actually on some of those impulses?
Right now, there's pretty much chaos in terms of who's going to govern going forward. This morning, the head of the Socialists said they would not join a coalition with Macron. That leaves him to cut a deal with the far left, and the far left will certainly want to get commitments on their priorities, which include significant spending and a rollback of some of the reforms that President Macron has pursued. So until we see what the coalition really looks like and how capable it is of operating, it's hard to say exactly what's going to happen.
So growth is a priority in France. It's going to be hard perhaps to get there. The UK also has a priority of growth right now. They have a new government, not nearly as surprising a result as we saw in France, more centrist actually. At the same time, what are the challenges actually for the new government in Great Britain to actually get the sort of investment they need for true growth?
Well, the surprise there was really the size of the victory of Labour after 14 years of a conservative government. And as you said, Labour has really moved to the center over the last several years under Starmer and under his leadership. So they'll now have to look at what they can do to restore growth as well. And he's talking a lot like Biden economics in terms of addressing fiscal issues, addressing reforms, investing in key sectors. And I think we'll be able to see whether he's able to deliver on that.
And of course, it's interesting that all of these leaders that we're talking about, both, of course, Macron and Starmer in the UK, are going to be coming to NATO this week. And Starmer arguably has the strongest position right now, at least when it comes to back home. But when you think about this confluence, everyone coming together at NATO, I mean, well, how are you expecting the future of NATO to look like with this new leadership in place?
Well, it's a critical time for NATO. On one hand, NATO is stronger than it's been for decades, really. It's enlarged with Sweden and Finland having joined. More countries are putting up more than 2% of GDP for defense than they ever have. I think over 20 countries now have reached that goal. There'll be a big focus, of course, on Ukraine. Ukraine will not be offered membership in NATO per se, but I think the countries around the table will want to be doing everything they can to demonstrate their unity and their support for Ukraine, including mobilizing more military support and some other actions like opening up a NATO office in Kyiv, setting up a training center in Germany for Ukrainian officers, those kinds of activities to further integrate Ukraine into the West, but stopping short of NATO membership, which they feel is a red line for Putin and a red line for many of the NATO members themselves.
Where should we look for leadership at NATO right now? I mean, typically you'd say the United States. President Biden obviously is in an election campaign that is not going entirely smoothly, I think it's fair to say. You've had experience in the government, has seen that relationship between the domestic politics and the power in terms of foreign relations. As you look at NATO, what does President Biden need to accomplish this week?
This is an important week, I think, for President Biden and for U.S. leadership of NATO more generally. There's a big effort in NATO to try and protect it from volatility in the U.S. elections as well. They know that former President Trump is not as much of a fan of NATO as President Biden, that he's unlikely to be as supportive of Ukraine as President Biden is, and they want to do everything they can between now and the election to what they call Trump-proof the alliance, including changing some of the command structures so that some of the efforts to send NATO armaments to Ukraine are managed by a NATO force rather than by an American force. So those are the kind of activities that will be going on this week. But I think something like 30 countries have signed bilateral security arrangements with Ukraine, including the United States. It's short of NATO membership per se, but these are the kind of security guarantees that the U.S. has with a number of other countries, including Israel, and it's an important demonstration of our commitment to them, and President Biden will want to reinforce and reassure the alliance partners that the U.S. will be there regardless of what happens with the election.
And unfortunately, we have just under a minute left. But speaking of the election, when you think about President Biden and what a President Trump looks like, how much daylight is there actually between what this means in terms of trade policies and, of course, economic policy as well?
I think in certain areas there's likely to be a fair amount of continuity between the two. There's bipartisan consensus, for example, on China. Some difference in tactics, how much the Trump administration wants to, or President Trump wants to raise tariffs on China, 60%, 10% on all imports from all over the world. That could have a significant impact on our economy. But when it comes to trade and to China, I think there is a fair degree of continuity. Where the big differences are, in my view, it's really around Ukraine and Russia and around how to partner with allies and other partners around the world, and how much of a commitment to have to working with them on some of the global issues we face.
Well, Michael, really appreciate your time on this Monday. That, of course, is Michael Froman. He is Counsel on Foreign Relations President. And David, who else do we have coming up?
So we're going to take a couple days off because we're going to hear from Jay Powell, right?
Right.
For the next couple of days. And then Thursday, we'll be back with Professor Catherine Judge of Columbia. She's going to be talking about those reserve requirements that are pending for banks as we get into bank earnings.
All right. Our thanks, of course, to Bloomberg's David Westin. This is Bloomberg.
Let's get to the trading diary, what you need to be watching this week. We get the New York Fed inflation expectations at 11 a.m. And then Jay Powell himself will deliver his semi-annual testimony on Capitol Hill tomorrow and Wednesday. That used to be called Humphrey Hawkins. On Thursday, we're going to get CPI, so more inflation data. And then on Friday, earnings season kicks off in earnest with JP Morgan, Wells Fargo, and Citigroup among the big banks reporting. And we have a ton of really exciting guests coming on over the next few days as well. Sonali, what are you most excited about?
You know, it's so much going on with Jay Powell testifying tomorrow, bank earnings Friday. I'm excited to talk to Torsten Slok tomorrow, but also we have Carson Block at the end of the week to talk about the markets. We know he had that short against Blackstone, one of their real estate investment trusts here. Of course, also tied to rates, Steve Eisman we have this week as well, Neuberger Berman. Fran Horowitz, the CEO of Abercrombie & Fitch. I've got to say, I do still wear a lot of Abercrombie.
I am so excited for this conversation. We talk about NVIDIA all the time. You take a look at Abercrombie shares over the past year, they're up 382%.
Better performer.
How do you engineer a brand to become cool again? Because, I mean, Abercrombie, that was big when we were in high school.
Are you saying I'm not cool?
No, I'm saying it's cool now, and you're wearing it as proof. But it wasn't cool for a long time, and now it's cool again.
And even Corning, you see so many other companies really being impacted by the AI trade that are not NVIDIA, and you have to wonder if investors are starting to broaden out at least just a little bit here.
All right, I'm looking forward to all those conversations and more. Did you know that I have a Torsten Slok button on my Bloomberg terminal? I have a Slok button, so if I just push this button, I get all the emails from Torsten because he gives us such awesome little pieces of knowledge.
That's so funny because I actually have a Matt Miller button because you email quite frequently.
We need an open interest button after this show too.
Yeah, I'm gonna spend the next 24 hours putting that together. But that does it for Bloomberg Open Interest. Seema Shah, Principal Asset Management. She joins Bloomberg Technology next. This is Bloomberg.